In problem 2.1, we are dealing with Satterfield's custom glass with the following financial information presented here in cells A4 through B12. So the first thing that we're asked to do is to prepare a schedule of cost of goods manufactured. And I think that these sorts of questions are asked outside of use of Excel, where here I wouldn't really think that you would have to prepare a particular schedule. But the idea here is cost of goods manufactured. What we want to think about is what data do we use over here to calculate the cost of goods manufactured. And what this really is this is the transfer from work in process to finished goods during the period. So what left work in process and went into finished goods? So in order to determine this, we have to sort out or conduct an account analysis of work in process. So we would want to pick up the beginning and ending numbers as an item to work through, as well as what the additions to work in process were during the period. So the cost of goods manufactured would take the amount that we started with, add, and since these are all the additions to work in process, I will highlight these here, the direct materials, direct labor, and overhead, and then subtract the ending work in process balance. So the amount of the cost of goods manufactured, that is what went from work in process to finished goods, was $7,110,000. Now, a few things to keep in mind. First, we are told what the overhead number was. This may be something that we would have to apply as we did with the predetermined overhead rate earlier. Secondly, direct materials are given. Generally speaking, these would not be given. The amount of direct materials would be something that we would calculate by doing an account analysis of the raw materials inventory account. But this problem is a bit of a simplification. So they've given us this number already computed. Well, the next thing we're asked to do is prepare an income statement. Now, cost of goods manufactured is a transfer from work in process to finished goods, not what ends up on the income statement. What ends up on the income statement is the cost of goods sold number. So similarly, this is a transfer from finished goods to the income statement in the form of the cost of goods sold number. So that means that we must conduct an account analysis of finished goods. So our cost of goods sold number, following the account analysis of finished goods, would take into account these analyses. So the cost of goods sold number will be our beginning finished goods inventory plus what was added, the cost of goods manufactured, which gives us the cost of goods that are available for sale. And then if we reduce that by the amount that's remaining in finished goods, those that are unsold, that gives us the cost of goods sold number, which is $7,210,000. At this point, we're ready to construct an income statement. So in good form, we would take our company name, then we'll have an income statement for the year ended 12/31/14. Because we may be looking into the future here. So our sales number is given over here. So we can make sure that we have this item in here. So we have our sales number taken care of, our cost of goods sold from above. So these are actual account titles. Then in the income statement, we have a couple calculations. So we take the sales number and subtract that, and that gives us, well, our margin over our production costs. So we call this number gross profit or gross margin. And then we have our operating expenses or selling administrative expenses. I guess we could be consistent with that heading here. So we'll take the selling administrative expenses here. And then as it turns out, when we calculate the net income number here, we end up having a $60,000 loss. So the net income is actually a $60,000 loss. So we're told that to ignore the income tax effects of this, so we will, but in fact that would generate a benefit in terms of reduced taxes moving forward.